week. It's time now for the big picture. And for that, let's welcome in our guest from the team right here at Charles Schwab. Michelle Gibley, Director of International Research for Charles Schwab, joins us now on this Friday. It is great to have you here. Thank you so much for taking a few minutes of your busy Friday. So let's start here, obviously, with what has been, Michelle, the top story for the markets and much of the world today. Do you believe this tension we're seeing right now in the Middle East could be more of a headwind for crude oil as we move forward?
Yeah, I think there's a lot of things we still don't know, and certainly there are concerns. It's being reflected in the oil prices. Military conflict in the Middle East, if it does result in reduced oil supply, could be a headwind to growth. So far, we haven't seen Israel target energy infrastructure. We don't know yet the fallout from Iran's retaliation right now, but that's something that could happen. Of course, we've been talking about the Strait of Hormuz today and any reduction in supply coming through there, and a potential for it to spill over into a wider conflict across the region. But I think investors probably should avoid overreacting to geopolitical developments. They don't typically have a long-lasting impact on markets if there's no significant disruption to energy supplies. And oil prices could rise further, but there is ample spare production of oil globally.
So I know that you just said investors should not overreact to the world of geopolitics, but I wonder at what point might you begin to think, Michelle, that what we are seeing out of the Middle East is suddenly becoming much more of a sustained market event?
I think that'll take time to know. We would have to see oil prices rise much higher and be sustained. We don't know if that would happen. Hopefully it will not. But right now, it doesn't look like that's in the cards.
Michelle, I do want to get your perspective on what we're seeing out of Japanese government bonds and the Bank of Japan. They are set to meet next week, much like our Fed here is in the United States. But unlike the monetary pressures we're facing here at home, every sort of different global bank has their own set of considerations. Do you see the Bank of Japan perhaps raising rates next week?
The Bank of Japan is on a rate hiking cycle, but they're probably not going to raise rates next week. We certainly have some memory of a year ago when we had the unwind of the yen carry trade. But the Bank of Japan is actually potentially likely to reduce the pace of QT, so they could make smaller reductions to their balance sheet to kind of ease pressure on those longer duration Japanese government bonds. If we think about this year versus last year, I often get this question about, are we seeing an unwinded yen carry trade? Could it happen again? But if we look at the positioning, short-term speculators a year ago were very much short yen, and now they're very long yen. And so they would not need to quickly cover those shorts if the yen rises. I mean, that all said, JGB yields are rising and becoming more attractive. So, institutions such as banks, pension plans, and insurance companies in Japan may make portfolio allocation decisions to bring back money to Japan, but they're likely to do this very slowly over time and not kind of like in a forced overnight way like we saw with short covering a year ago.
We all remember, I should say, where we were during that great yen carry trade fueled sell-off here last August in the United States. While I still have you, Michelle, before I let you go, my friend, what stands out from global markets as they recover from the losses we saw in April?
Yeah, I think, the excessive tariff rates that we saw in the wake of Liberation Day may be off the table, but there's still uncertainty over how these higher tariff rates will impact economic growth because rates are still higher than they were at the beginning of the year. And now there are signs that goods arriving from China to the U.S. May be accelerating as soon as next week. So they're on their way. It took a little time to get here after the de-escalation on May 12th. Ships had to arrive back in Chinese ports and make their way across the ocean. But given the pull forward that we saw of purchases in Q1 in the U.S. and the higher tariffs on the goods, U.S. goods demand could slow. But what we saw in China is that their exports to the U.S., even though they fell 34% in May, exports to the rest of the world rose 11%. So they could, find ways to other destinations for their exports. We don't really know how much growth will slow in coming quarters globally, but we could see more tariff-related disruptions.
All right, my special thanks there to Michelle Gibley, Director of International Research for Charles Schwab. Michelle, thank you.